Benjamin Graham's The Intelligent Investor is a classic on value investing. Every investor should read it at least once in their lifetime. At the age of 19, Warren Buffett read The Intelligent Investor, and later when he attended Columbia Business School, the book's author, Benjamin Graham, became Buffett's professor. The book has been called by Warren Buffett the best investing book ever written, and they definitely slapped that all over the covers. Beginners can definitely read it, but if you have a basic understanding of how the stock market works in investing, it will be very helpful. It may be helpful for you to know a couple of terms before you begin reading this book if this is all new to you. It isn't the easiest book in the world to read, but you can get the version with the commentary chapters. In the book, Benjamin Graham discusses the difference between investment and speculation. When investing and not speculating, he says 3 goals should be met, such as analyzing fundamentals thoroughly, seeking safe and steady returns, and protecting against loss. We'll discuss these in further detail in the following sections. Number 1, you need to determine what type of investor you are. This book categorizes the types of investors in 2 ways: the active or enterprising investor and the passive or defensive investor, an active or enterprising investor. You'll have to spend more time on this type of investing since you're always researching and analyzing the fundamentals of different stocks and bonds. Most passive and defensive investors have a long-term portfolio they'd like to just put on autopilot most of the time. They may include ETFs or different types of funds in their portfolios since that makes it a little easier to manage and they don't have to research and analyze those individual stocks. You don't have to spend as much time researching and analyzing stocks if you invest passively. Let's not forget that no matter which way you decide, you'll have to keep your emotions out of your investing decisions, because stock prices fluctuate. You still need to be able to handle all the highs and lows of the market if you're a passive investor. Number 2, invest in order to protect yourself against inflation. For example, if you had $1 in 1900, you could buy 70 pounds of potatoes. Inflation occurs when the dollar loses its purchasing power. If you had $1 today, you would be lucky if you could find a pack of gum or candy for less than $1. When discussing inflation, Benjamin Graham also discusses this psychological phenomenon known as the money illusion. As an example, he gives a scenario where inflation is going up, meaning the dollar is losing value, but you get a raise. As a result, the raise doesn't actually make up for the inflation rate, so you end up losing money, but we tend to overlook that because of the feel-good effect of receiving that first raise. He is trying to convey that if you had $2 and put $1 in a bank account or under your mattress, and you invested the other, that dollar will have a much greater chance of growing over time than that dollar that sits under your mattress and just loses value over time. Number 3, the importance of fundamental analysis. You should make your investment decisions based on numbers and performance, rather than emotions or type, according to the author. When selecting stocks, Benjamin Graham considered these factors. Earnings per share, P/E ratio, and long-term growth rate are just some of the factors he considered. Thus, throughout his book, Benjamin Graham emphasizes the importance of fundamental analysis and discusses the importance of investing in companies whose stocks are performing well rather than the ones you know. In other words, even if you know and you like a company and you use it, those feelings do not necessarily override the company's actual performance. Consequently, he believed that even if you liked a company, if the numbers didn't line up, you shouldn't necessarily invest in it, even if you were familiar with its name. Number 4, value investing. We just talked about fundamental analysis, and its goal is to determine a company's intrinsic value. In other words, how much a company is actually worth once it is determined what its intrinsic value is. Investing in value involves finding companies that trade under their intrinsic values. Investing in undervalued stocks was Benjamin Graham's investing strategy. You've probably heard it many times, but diversification is key, and the intelligent investor definitely emphasizes this. Specifically, Benjamin Graham emphasizes diversifying your portfolio with stocks and bonds, and he also mentions adding REITs or different funds to your portfolio for further diversification. However, how you diversify is entirely up to you.